Good morning, good afternoon, or good evening, and welcome to the Bull versus Bear webinar here on Thursday, the 14th of December, 2023. Steve Miley, as ever, on the call in here for Trade Day. Welcome, everyone. Welcome. Going to go through our usual run through in here today. A lot of focus on the Fed, a lot of focus on, the aftermath of that and what it means for today and going forward. Yeah, I don't want to toot my own trumpet, but when you get it right, you got to say you got it right, okay? And we've been talking about this a lot. Anyone who comes on the webinars, I've been talking about the bonds pushing higher, starting to indicate a pivot from the Fed. I've been talking a lot about this CME Fed Watch tool, continue to price in more aggressive rate cuts coming. Continue to talk about potentially a more dovish Fed in the pipeline, and they were starting to pivot. We were getting the signs from some of the hawks in the Fed before the blackout period, slightly moving to slightly more dovish. And, we got the confirmation of all of that in the last 24, 48 hours with the inflation report, not particularly better than expected, but not massively worse than expected. And then yesterday with the Fed, definitely with a pivot to more dovish in here. So I'm going to start off in here. I don't usually start here, but even in January's meeting now, it's pretty much. I mean, I don't think they're going to do anything in January. But look, the market pricing in potentially even a rate cut, 16.5% chance of a rate cut in January. But now by March, we've been talking about this pushing back up to above 60, 70. Look, 74 plus 14 in here. There's only an 11.7 chance the market thinks that rates won't be lower come March next year. And we've been talking about focusing on this a lot. I've been talking about the first rate cut coming in the first quarter of next year at the March meeting. And, this went high. It was going to take stocks with it. And that's exactly what's happened, right? So blow your own trumpet where you can, Steve, right? So, and the Fed basically told us, let me take you to the dot plot chart. So in here we were pricing in like 4 rate cuts. Let's put Fed in there so we get it right. And then I will go from there it is. Yes, yesterday's one. So on the Fed dot plot chart, remember this is the bit we're interested in. This is that comes in their summary of economic projections. We get this, I think, 4 times a year. 3 or 4 times a year. And then here's the dot plot chart, or end of year, they knew where it was, so no surprises, that's all in the line. But in here, basically what is pricing in there is up to 3 rate cuts, okay? So is the median forecast in here. So taking rates from where they are now at 525 to 550, down to then, what does that put us at? That 3 rate cuts, 450 to 475 range, right? 450 to 475. And if we go take a look at the dot plot, that's where the median is in here, the 450 to 475. That's where the most of them are. And that's also, so it's like the mean and the median and the mode, I think. So any kind of average you're looking at is taken in there. We do have potential for it to go be even below there, but that's pretty much where the mean, the median, the average is from the Fed. Okay, so we've certainly the Fed delivered that. And before, if you remember, when we looked at remember that dot plot is for the end of the end of 2024. By the end of 2024, that's what it represents. Okay, now if you remember yesterday when we looked at this for the 18th of December, for the end of the year, it was saying basically 4 rate cuts. Okay, now if we look where we're at, so remember the Fed are telling us they are likely to be at the, what did I say, the 450 to 475 range. If we look at the CME now, they've got us pricing in somewhere between 350 and 4. Okay, 350 to 4. So far more aggressive pricing in. What you can do, by the way, guys, if you haven't looked it over here, you can do the historical. So we're going to do historical for the 18th of December. So if we go and click on historical, and we're going to look at historical, what were the chances of it being, so where are we now? So let me just go back to the current. So in here, for let's say it's being for 375 to 400. Let's have a look at the historical of the 375 to 400. What it's going to show us is pretty much 0 chance, right? Up until yesterday, 0 chance or super low chance in here of there being any rate cut, right? And now we've got a significantly higher chance, but back here, only in October, November, effectively zero chance of us being that low in rates, okay? And then even yesterday in here, if I go back to the 400 to so let's say 75. No, it was pricing in from down to like I think down to let me just go to the current. So we're current 525. It was pricing in. The market was expecting 425 to 450. That's what the market was pricing in, right? So if I go back to the historical 425 to 450, we go take a look at that. Yesterday. This doesn't look right. Oh, now it's very unlikely. So this is obviously collapsed now. Why is this collapsed? Because basically the market's not expecting any expectation of 425 to 450 because we're looking at far more aggressive rate cuts. So we only had a 25% chance. Now we're going to be way below that 425. There was just an outside chart, a 25% chance that we would get down to 425, 450 by the end of the year. That's what the market was pricing in. Now the market's pricing in very little chance of that because the market's pricing in far, far, far more aggressive rate cuts. Okay, so significant move. Okay, a significant shift, and the market now pricing in more like 6-7 rate cuts or up to 8. I think I read this morning, depending on where you look as well, and some of the economic forecasters, and the Fed telling us it's basically going to be 3, and we were looking for 4 yesterday. So what happened was bonds surged higher right the way across the curve, 30-year, 10-year, 5-year, but really the 2-year leading the way, going back up through the hole. But you see the 2-year far more aggressive move. Why? Because it's the 2-year is closer to the shorter end, is the short end of the yield curve. The shorter end of the yield curve is more prone to movements from the central bank. The longer end of the yield curve reacts more to the economic conditions. Okay, so that's why the short end led us higher yesterday. And there we see the 10-year yield plunging lower in here. So this was yesterday's price chart in the 10-year, surging higher. And then if we go look at the yield chart this morning, we'll come back to the price chart in a little while, but you can see in here that was yesterday, and then overnight we've gone even lower in yield. Now the other thing I really want to point out in here, I spoke earlier in the week about European bunds, the bund market pushing to significantly higher prices, lower yields. And we go and look at now here we have here's the bund chart again. That's the bubble chart. Where's the bund? I haven't got the bund on here. Let me go and switch to the intraday. I've got the bunds on the intraday. So this is the German government bond. The Bund future, you can see yesterday, this is a daily chart. Forget that. It says 6 hours there. That was yesterday and then higher again today. So the Bund chart was leading us up anyway more recently. Then the US bonds took back over again yesterday. But you can see European government bonds also pushing higher. Remember, we have the ECB and the Bank of England in here today. And if I go back to that other chart where are we on my dailies? And here, and we go here. This is the gilt chart. Now the gilts jumped. Gilts are UK government bonds, okay? UK gilts massively higher yesterday. This was ahead of the Fed, and then this move over this morning. That's because this market was closed by the time the Fed came out. So there's a big push high, and that was because of that data we had yesterday. Remember, we had that GDP data which shows the UK potentially slowing down, maybe moving towards recession. So now a real anticipation that the UK is going to join, potentially into next year, be joining the rate cutting that we're likely to see from the Fed and potentially from the ECB. So we had this push higher, and if I go and show you the UK gilt chart, yield chart in here, you can see this plunge lower yesterday, and then again in here this morning, lowering yields. So we dropped from like basically 4% yields at the start of yesterday to like 3.7. We've been up in here like 475, but we're a whole 1 point lower in here than where we were back here at the end of October. So the main reason I'm showing you this, guys, is this is not a US phenomena, right? This is global central banks in here, all of the bond markets in here rallying, going up in price, down in yield, and that's because of anticipation of central banks pivoting far more aggressively than we previously thought. And I've been talking about this loads and loads. When you see me on my TV interviews, I've been talking about potentially a more dovish Fed. I've been talking about bond markets rallying, going to lower yields. That's what I've been really pushing. It's been my belief that the central banks would have to, that the inflation was coming under control and was looking better than expected, and they really don't want us to push into recession. So, and they've got plenty of bullets in the gun, i.e., rate cutting potential. So that's what we've seen come through in the last 24. Well, it's been developing really since November, but we've seen it in the last 24 hours. And then what does that mean from the index side? Well, obviously the indexes took off, the indices took off as well. S&P and the Nasdaq in here. The S&P flying up, as we said, potentially. Look, we were looking at this high. I said this 2 days ago through CPI and Fed, looking for this high on the March contract to be overcome. So we're at new highs for the year now on the futures markets as well. We're already on new highs on the cash market. And the Dow Jones, which we don't focus on nearly as much, the Dow Jones actually made a new all-time high yesterday. Okay. So what do we have coming into today? Well, we have had the S&P already. I haven't actually had a chance to look at this yet, but we've had the S&P already in here and the Bank of England. I haven't had. I've been super busy with other stuff this morning, so I haven't had a real chance to look at these in here this morning. But in here, the anticipation was a vote for a hike was 3, vote for unchanged at 6. Look, the vote for the hike was 2. So there's still votes in there for a hike. So this is kind of still a little bit in here, even though they left rates unchanged. The anticipation was for only 2 votes for a rate hike, and we got 3 votes for a rate hike. So there's still some hawkishness in the Bank of England there. I haven't had a chance to see, obviously, S&P. None of these were expecting to change rates anyway, right? But it's going to be the tone. I haven't had a look at the S&P press conference yet, but the tone for the Bank of England a little bit more hawkish than we maybe would have expected in there, and that's why you see in here the bonds in here. If you go back to the bonds this morning in here, so gilts jumped higher, okay, after the Fed, and then they've gone back down lower in price, higher in yields, okay. They're still at lower yields than they were yesterday, but they're backing off from those high prices, okay, those low yield points in here. And that's because that's slightly still hawkish tone from the Bank of England. But, stocks in here just absolutely flying and looking really positive. So we've had that. We've got the ECB coming up in about half an hour. Really more of the focus on the press conference. We're not expecting anything in here. Also, retail sales in 50 minutes from the US. So the monetary policy statement and decision, we will be needing to watch that as well in just over 30 minutes. And then just over 45 minutes in here, we get retail sales from the US, watching that as well. And then the ECB press conference thereafter, watching that as well. That's going to be Lagarde speaking as well later, ECB President Lagarde, watching out for any kind of clues there if there is going to be a dovish shift as well from the ECB. So looking for these dovish shifts to come across the central banks in here. So everything rally, obviously everything was up, bond markets up, stocks were up yesterday on the back of all of this, so saw significant moves higher in here across the globe, not just in the US. The Fed pivot saw markets and companies rush to rewrite their forecasts. Investors are now pricing in, this is the dot plot, this is the CME Fed tool basically, are now pricing 6 cuts in here, 6 cuts, where the Feds tell us there's going to be 3. Okay, so the market's always going to get ahead. Goldman Sachs in here now saying 3 consecutive rate cuts coming from March. Okay, so March, May, and June, they're looking for 25, 25, 25 in here. There's still some room for disagreement in markets in here. So, yeah, we know that. Markets and markets in here. Bill Gross versus Gundlach in here. All eyes on Europe, as we said in here. European Central Bank, Bank of England. We've already had the Bank of England. S&P was there already. And then hawkish surprises are still possible in here. So Norway, they hiked this morning in here. So there's still some surprises potentially out there with most central banks pivoting to more dovish. So no, dovish Fed spurs stock rally. We know all of this. Nothing new in here. Everything looks bullish. 10-year Treasury yields below 4%. First time since August. Wall Street traders go all in on great monetary pivot. This is all. I've been talking about this for not only days, weeks, into months now, that I was looking for this pivot. I think we're going to get a really strong stock and bond rally right the way through into the holiday season. There's going to be pullbacks, right? And there's going to be bear moves. But I think we could really take off and fly now. I think this has caught the market a little. The dovish shift has been more aggressive than the market kind of probably thought. And now there's a lot of anticipation of aggressive rate cuts. And we could see a real strong Santa rally, if you want to call it that. But we've already had the market's been rallying since the beginning of November, right? We're up wherever we are now, 10-15%, and it looks like it can go even higher in here into year end and early January. Morning bid matching the Fed's green light. Yeah, and there's nothing really to add in here on the markets. If I look in here, there's the strong rally overnight. We went high, we had a little dip, and it's consolidated. This is the Nasdaq. Looking super strong in here. The only concern is that we are getting overbought. You look at your overbought indicators on the dailies. We're getting overbought, but can it go higher again today? I think it can. There's the ES, again, pumping higher, then up overnight, and then consolidating higher as well. And there's the daily looking super strong. I think there's still room for us to push higher today. Maybe you get some position squaring and a consolidation tomorrow, but my view is it stays all very bullish. Overnight, Hang Seng followed the US and European averages higher. The Nikkei actually dipped overnight in here, but you can see in here this morning, FTSE playing catch. Remember, these markets, cash markets in here, are closed by the time the Fed come out in Europe. So the FTSE is up 2% today. That's the UK index, and also because there's anticipation of the Bank of England becoming more dovish, shifting to more dovish, even though they sent that kind of slightly hawkish signal this morning. The French CAC up 1%, the DAX, the German DAX up 0.68, and we already looked at this. We had 1 to 1.5% rallies yesterday, and we're up again in here. So, I can't say anything other than I'm bullish in here today, guys. I've been bullish. I'm staying bullish. The Fed have delivered what I kind of expected them to deliver, and for me, you're playing it from the long side. And unless you're a very, very short-term trader, I'm buying dips all the time in here. I think it's going to be. There might be well, have a look at it again tomorrow. I think it looks a little overstretched tomorrow. There might be a sell opportunity tomorrow, but for me, it's playing it from the long side still. Any questions? Now, to remind you guys, we've got a Q&A in the Discord. The Discord Q&A is today. Now, that is at, I meant to publicise that all week and haven't been because we've had so much other stuff to talk about. I know my time, it's 4 p.m. So I'm in the UK. That's 1600. So it's 1600 UK. That means it's -5 is 11 o'clock in the morning if you're in Eastern. So that put us at 10 o'clock Central. So 10 o'clock Central, I'm not going to do all the hours. Mountain time, then I guess 9, and Pacific time 8, I think, right? So it's 1600 GMT, which is -5, 11 o'clock Eastern, and then -6, which is 16 minus 6 is 10 o'clock AM if you're on Central. So, and if you're in Central European time, it's 1 hour ahead. So it's going to be 5 p.m. if you're on Central European time. And you can work out where you are from there if you're on the rest of the planet. So do join us, bring your questions, or just come to listen. It's in the Discord. If you're not a member of the Discord, join the Discord. We can send you instructions if you don't know how to do that. If you're not a member of the Discord, we'll play also in where do we normally play? I think it's in here. We play it in here. I'm not sure. I think we play it in here, but we'll try and play it onto the website as well. But if not, go ahead and join the Discord. That's the easiest and quickest way to. And if you need some more information of where it's going to be playing on the website here, send us back. But I think it'll be in here. If not, in the resources tab, drop under the resources tab, and it might be in the. I think sometimes before we've put it in Trader Talk. I think we've called it, or the Trader Mind session, maybe the Trader Mind area. But I think easiest thing to do, guys, is go into Discord and watch from Discord and ask your questions in there. James and I will be asking anything you want to do. Talk to about trading, about trade day, about markets, whatever you want. Okay. All right, guys, I'm going to wrap it up there. Please do join us at the Discord Q&A. I'll be back with you then, and then also back with you tomorrow for the final Bull versus Bear webinar of the week. Take care. Bye.